Merry Christmas, Bowtie Nation. Joseph Hogue with a quick video to wish all of you a happy holidays and some ideas to make your 2026 even happier. Just an informal video here quick because I want to get back to my family and get you back to yours for the holidays. First up, and probably most important, this is going to be your last week to lower your 2026 tax bill. Okay, any investing platform or brokerage account is going to show how much in long-term capital gains and short-term capital gains you have so far this year. You're going to owe taxes on those next year, so you better know where they are and how to offset some of those. You can see here the difference. Any short-term capital gains, so stocks that you've sold that you've held for less than a year, maybe options that expired or options you've sold that you held. Almost all options expire or are sold as short-term capital gains. So any of those are added to your income. You can see your income tax rates go all the way up to 37% here, whereas long-term capital gains, so those stocks that you sell after holding for more than a year, or the options that maybe covered call strategy that go against your stock gets called away. If you held that stock for longer than a year, that's going to be long-term capital gains. That's going to be only 15 or 20%. Now, what's important is that these short-term and long-term capital gains or losses can cancel out. If you have $100,000 in long-term gains, $100,000 in short-term losses, those cancel out and you won't have any tax owed coming this tax season. What's important here is first, understand how much in short-term and how much in long-term capital gains you have right now so far this year. Then look in your portfolio. Maybe you can sell a stock with a loss that can go against some of your short-term gains or can go against some of your long-term gains. Remember, they cancel out. So if you want to lower your taxes, you're going to have to find some losses that are still in your portfolio to go against any capital gains tax that you might owe or any capital gains in your that you've already sold over so far this year. Very important for options investing, whether you're long the option or short the option. So whether you've bought the option or you've sold that option to another investor, long options, generally how long you hold that option before you sell it determines your tax rate. So if you buy a call option, you sell it more than a year later, that's a long-term capital gains or losses. Same thing with puts. With your exercising there are no taxes until you sell that stock. So if you buy a call option, you exercise that, you get the stock, there's no tax owed until you sell that stock, okay? And then that is how long you hold the stock. That's your holding period. That's your long-term or short-term. For short calls and puts, very important here because these generally either are sold or are exercised as short-term capital gains or losses, okay? So you need to know if you're selling calls against some of your stocks, if you buy those calls back, those are whatever you make in that option, you're going to be paying short-term capital gains on. So very important, you know what that's going to do, and especially what it's going to do next year, okay? Not just what you owe in taxes for this year when you go to file your taxes in April, but what are your positions right now in your portfolio? What is that going to do to your taxes for next year? And how can you manage that? Maybe if you're going to have a lot of short-term capital gains next year from some of those options that you own that are going to expire or be used next year, maybe you save some of your losses from this year for next year to offset those as well. I know it's a lot to think about, folks, and the different taxation in different types of options or stocks, whether you held it long-term or short-term, it can be confusing, but this is something you really want to think about. You want to spend your time on over the next week before December 31st so you can manage that tax situation and not have a big tax bill waiting for you come April of next year. Another important idea here, one that came to me over the hundreds of portfolio reviews that I've been doing lately. A lot of you have submitted your portfolios for a review here a couple of months ago. I'm just now starting to get those. If you haven't gotten that email, look for that email about 2 weeks ago for the sign-up link to your portfolio review. But within these portfolio reviews, I've noticed a lot of investors are holding a lot of cash in their account. The average cash at 30% of the portfolio across those hundreds of investors, many of them more than half. And I feel you, folks. I feel you that the market is expensive right now, but it always feels that way until a crash. And then you're worried it's going to fall further. So the point is there's really no right time if you're holding all this cash, just waiting for the right time to put that to work in the market. There's really no right time because it either always feels expensive or it's always that fear around a crash that you don't want it to fall further and lose your hard-earned money. Oh, by the same token, there's no right answer for how much cash you should have, but I like to keep it with less than 10%. And now that's not including bonds. Okay, that does not include cash you need in less than 1 to 2 years. So it's okay to have some cash in your portfolio. Just understand you're not making any money off of that. I'm going to show you some bonds, some other investments, very safe investments, where to put that cash instead here in a minute. But you do generally want 5 to 10% of your money in cash. That way, if the market does come down, you have cash ready to buy back in on that dip, as well as if there's any emergency expenses you need to pay, you can use that cash rather than having to sell stocks at the last minute. Your first option here for your cash is going to be bond funds, bond ETFs. Now, these ETFs hold thousands or even sometimes even tens of thousands of bonds. Those are debt investments issued by either the government or companies. So they are much safer than stocks. They generally pay a good interest rate or a yield, a dividend yield you get with the ETFs. And I'm going to go through 3 types of bond funds that you can invest in. Put that cash to work. They can be just as safe as cash and make you a little bit better return than maybe the 1% or the 1.5% you might be making from your savings or from a money market account. First one up here is going to be the iShares 20-year Treasury Bond ETF, that ticker TLT. Now, this pays a 4.3% dividend yield, so a solid dividend yield. These are treasury bonds. Okay, so these are the safest of the safe. These are just up from money markets as far as how safe they are. If the U.S. government stops paying the interest on its treasury bonds, there is going to be more to worry about than just the cash or the investments in your account. Okay, so that's going to be an apocalypse situation. So these are really safe. You can see here over the year to date, not really much of a return. You're really basically just getting that safety and that 4.3% yield on your money there. Next step up would be the Vanguard Short-Term Bond Index Fund ETF, that ticker BSV. You can see this pays a little bit less in yield, 3.8% dividend yield. It is extremely safe though. These are very short-term bonds issued by companies with very high investment grade status. Okay, so these are AAA rated companies, some companies with credit ratings even higher than the U.S. government. These companies are going to pay their bonds back. One step above that would be the Vanguard Total Bond Market Index Fund, the BND. Now, whereas that BSV, that just invested in shorter term bonds, this total bond market, this invests in everything. This is going to invest in the treasury bonds there, the short term bonds, the longer term bonds, 3.8% dividend yield. So you get a little bit more for a little bit more risk, but it's completely spread out across the bond market. Very safe, excellent excellent resource or destination for your cash to make a little bit extra return beyond what you're getting from cash savings account or even a money market. Option 2 for that cash, and anytime you have cash you want to invest or are trying to decide when to invest in a stock, just invest gradually in that stock or in the market over the next 6 months. Okay, this is going to mean breaking down how much you have in cash or how much you want to invest into maybe 6 equal chunks, doing it each month instead of just all at once. Okay, what that's going to do, it's going to start getting you invested in that stock market or the stock. Make sure that if the stock goes up or if the market continues to go up, you get a return on that cash instead of just sitting it into a savings account and wishing for maybe a sell-off or a dip buying opportunity. You're going to start making the return on that. If the stocks do come down, though, then you're also going to have some cash set aside still. You're going to be able to buy in at those lower prices. So really stretches it out over 6 months, gives you a great opportunity to not only start investing your cash now, but hold some back, but it doesn't keep that cash in waiting for that right time. Option 3 for that cash here is a great opportunity to really spread out your portfolio, spread out the risks in looking at what assets or what sectors do you lack. Okay, we're looking here at the stock sector spider, the sector tracker, stocks year to date, the sectors. So parts of the economy, the technology stocks, communication services stocks, financial stocks, healthcare, what they've done. And what I find, a lot of investors through those portfolio reviews have almost everything in technology, have almost everything in communication services, those internet stocks there, but very little in some of these other stocks, utilities, healthcare, financials, maybe even real estate and consumer staples. Now that's worked this year because those sectors, the tech stocks and the communication services, have done so well, 25, 21% return over the past year for those stocks. But what happens if we do get some kind of a stock market crash or even a correction? These fall the hardest. So this is a great opportunity to take some of that cash and kind of diversify into some of those sectors that you might not have much of a position and that might not fall quite as hard as some of those tech stocks in a crash. So you can look here. I really like the XLRE. That's the ticker XLRE. That's the sector spider for real estate. That one here, you can see it owns 31 stocks in the real estate sector. Okay, so 31 REITs, real estate investment trusts. It's a great way to diversify your exposure into real estate stocks, get some of that exposure that hasn't held up very well this year, but it is a great hard asset to fight against inflation. It's already in value territory, so it's not going to fall quite as hard in a stock market crash. Consumer staples, that ticker XLP, that one is going to hold the 36 companies in the S&P 500 within the consumer staple space, okay? So you've got companies like Dollar General, Dollar Tree, Monster Beverage, you've got Altria Group, Coca-Cola, Kroger, all the companies that sell things that you pretty much need to buy, okay? Don't necessarily need to buy the stocks or the cigarettes from Altria Group, but people do anyway, and they don't stop buying them in a recession. So a lot of these companies selling things that are going to have some really strong recession fighting power there in the earnings, in the cash flows. Just an opportunity to maybe get that cash into some of these sectors that you don't have investments in otherwise, can really smooth out your portfolio. Next, I'll show you how to really put your portfolio into perspective and take some of the stress out of investing. But again, I want to wish everybody a Merry Christmas, Happy Holidays. Why don't you go ahead and make my holidays merry also by tapping that like button and subscribe to the channel so you don't miss a single episode. Now, one thing I've tried to do through all the portfolio reviews is really look at the big picture and put investing in perspective for people, because I think a lot of people, they find out how much return they actually need from their investments, and it takes the stress out, because when you see that you only need maybe 6 or 7 or 8% return from your investments to reach your goals, to reach that retirement number or whatever you want that money to do, then it takes a lot of the stress out, because you don't have to be chasing every new hot stock. You need a diversified portfolio that gets that return, and you don't have to be looking at stocks every day. You don't have to be worrying about your portfolio. So I want to show you this investment calculator. This is calculator.net. If you search for investment calculator on Google there, you'll find it. I like to go to the return rate here, and what you do, you start out, what does your end game look like? What do you want this money for? Okay, folks, if you don't know what you want that money for, if you don't have a mental picture of what life looks like in retirement or when you retire early, you're doing it all wrong, okay? This needs to be where you start, with that mental picture. What does life look like in retirement? What are the expenses to get that done, okay? For most people, their expenses are going to be pretty similar to what they have now in retirement, maybe a little less. So if your expenses right now are, we'll say $7,500, maybe you can get away with $6,500 in retirement, $6,500 a month in retirement for expenses. That's about the average or the medium for U.S. households. So if we say $6,500 a month in retirement for expenses, minus out maybe $1,500 for Social Security, pensions, other benefits, means you're going to need about $5,000 a month over each year in retirement. That's about $60,000 a year. Times 12. So you're going to need about $60,000 from your investments in retirement to live the life you want to live. Okay, this is what this is about, really getting that mental picture of what retirement looks like for you and how much that's going to cost. And so you can plan for that and know what you need to do to get there. So if we need $60,000 for retirement there, I'm going to use the 5% of that. Okay, so 5% rule, basically you multiply this by 20, or you take this divided by 5%. A lot of people like to use the 4% rule. It's a little bit safer, but I found you can take 5% out of your investments each year in retirement and not really have to worry about running out of money or anything. So if we divide that 60,000 divided by 0.05 or 5%, that gives you about $1.2 million you're going to need in retirement. So we change this to 1.2 million. And then we go down here to starting amount. This obviously is going to be, different for you. We're going to say let's say you've got about 200,000. Okay. That's about the average or the median for people around 35, 40 years old. Obviously you might be higher than this. You might be lower. Just play around with these numbers to see where you're at. And we're going to give you 25 years to invest to reach your number. Let's say you invest $500 a month. Okay, so you're trying to hit that target of $1.2 million in 25 years. You got about $200,000 now, and you're investing $500 a month. Hit this calculate here. We find out you only need 6% real return. Now that's return or after inflation. So if you add another maybe 2%, 2.5% inflation, you only need about 8.5% annual return to get to your magic number, to get your retirement number. Again, talking to people in those portfolio reviews, I found that it is a huge sigh of relief when they actually see how much return they actually need for on their investments. Okay, they realize they don't need to be stressing out about finding that next hot stock. They don't need to be stressing about how much they put into AI stocks and into the tech bubble or anything like that, because they only need 6-8% return. So maybe they can spread out their money a little bit, put a little bit more of that cash in bonds, put it into some of the safer sectors like again, like consumer staples, like real estate, things that aren't going to fall as hard in a recession or in a stock market crash and aren't going to freak them out when that happens. Okay, so a real eye opener, real wake up call for a lot of investors. So again, you can play around with these numbers here, figure out what that mental picture of retirement looks like, how much you're going to need, use that 5% rule. So whatever your expenses per month or per year in retirement are going to be, divide that by 0.05 or multiply it by 20, same thing there, to find your target number. Really important. You have that mental picture in your mind, though, that goal of what you're actually working for, why you're saving this money. Put in your starting amount, put in how much you contribute each month, and hit calculate. If you need more than, I'd say more than 10 or 15% return to get to your number there, I would say maybe extend the time. After more years, add some years there, maybe try to add a little bit of contribution. If you need less than 6% their return per year to get to your number, again, use that as a wake-up call. You don't need to be chasing stocks. You don't need to be investing all of your money in stocks. Invest in some safer bonds and invest in some safer assets. Maybe pull back a little bit on your monthly investing and just enjoy life. Watch the video to the right next to see how I'm investing in 2026 and the stocks I'm buying right now. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.